Brokers at the end of the day want a buyer who is a guaranteed close. That's how they get paid. We are essentially a guaranteed close. We have our transaction process down from PSA execution all the way to close of escrow. Brokers recognize that and they're willing to show us sometimes even exclusive looks where no other group will have a look.
Welcome to the Freedom Point Podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in.
Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer.
All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. I've got another amazing guest. I know I always say my guests are amazing, but this one's super special. I've got my friend and my colleague, Brady Baloun. Brady, welcome to the show.
Thanks for having me, Jimmy. Appreciate it.
Yeah, I'm really looking forward to chopping it up with you today. Listen, Brady is the director of acquisitions and transactions at Rise48 Equity, which is the company that I also work for. So I'm really looking forward to having Brady on the show to talk about something that I would say most investors and even capital partners are just unfamiliar with, and that is the topic of acquisitions and how we, identify and uncover investment opportunities. Most people are familiar with the fact that we want to sell the asset at some point. We've got, a debt structure, in place. We've got a business plan to execute. We want to maximize, investor returns. But what a lot of people fail to understand or have any knowledge in is where do we find these deals to begin with? And so that's why I wanted to have you on the show here, Brady. Maybe before we kind of, get too far into the conversation, you can let us know a little bit more about yourself, maybe kind of your journey, into the space and primarily what you focus on today.
Sure. Yeah, no, I appreciate it. Thanks for the intro. And yeah, I mean, ultimately, in short, I've really been with Rise48 Equity really since shortly after its inception, almost going on. It was founded 2019, going on almost 6 years now. And so I've really played every role with the company so far: investor relations, transactions, and then my current role today being director of acquisitions. Constantly sourcing deals, finding deals, underwriting deals. But before that, spent a little time, shortly after college at Charles Schwab, kind of in the high net worth portfolio services division there, kind of assisting RIAs that were on the Schwab platform, kind of portfolio manage for their clients. But I always had an interest in real estate, multifamily specifically. I don't know why. I just always loved the asset class of real estate, and so then I shortly pivoted from Charles Schwab over to a SFR firm called Progress Residential. They're a large conglomerate, really out of New York, from their parent company of Brady Partners. So they raise institutional capital and go to place them in SFR, single family homes across the U.S., large portfolios, and ultimately go that route. But there's still differences between that and multifamily, true multifamily. And so I had to, find my knack and try to pivot over into multifamily. And now I've been here with Rise48 Equity ever since. So it's been quite the ride.
That's great. Well, I appreciate your background, and you definitely, have a real strong, background and experience in this space. And I know that Rise 48, prides itself really on, sourcing large multifamily deals. And really, I think the listening audience would love to know kind of a little bit more about, deal sourcing and broker relationships. When you're kind of scanning, the markets that we currently operate in today, or maybe looking to go into, markets that we're not currently operating in, what are some of those kind of early signals or, patterns that tell you a deal is worth diving into before we even touch the underwriting?
Yeah, I mean, good question. It's on the commercial side, dealing with brokers is totally different than the single family traditional kind of process. So on the commercial side, the investment sales brokers really control your access to deals, and either selling or purchasing these large assets. Some of these investment sales brokers have sold that property over 5, 10 times, over the years. And ultimately, if you don't have a solid relationship with those brokers, they won't provide you with looks on various deals, or even off market looks, or pocket listings with you and a couple other groups. And so we pride ourselves on that, having, very well established broker relationships, in our Phoenix market, Dallas, Fort Worth, Carolinas as well. We're looking at new markets as well all the time, trying to track those demographics as well to see if it's a market we want to go into. And so, once we make that decision to enter a market, we'll fly out there, spend a week or two just setting up meeting after meeting with all the top investment sales brokers, understand the location, what they've been selling recently, and kind of the area and the market as a whole, different submarkets as well. So um, every day I'm constantly on the phone with brokers across all of our markets. Our acquisition team is fairly small. We don't have it broken out by regions at this time, but as we continue to gain scale, we'll get there for sure.
Yeah, no, that makes total sense. I know this is very much a relationship, based business, and I know that it's highly competitive. So how is it that being kind of the head of the acquisitions team, how do you keep brokers from picking up the phone and making sure you're the first to hear about new opportunities, as opposed to maybe other, sponsors or syndicators in the space?
Yeah, no, that's a great question as well. I mean, really, since the firm's inception, we've closed a total of 60 transactions. We have 100% close rate from PSA execution. We've never dropped a deal, never retrade a seller, and obviously we have very preferred terms in terms of earnest money, and kind of, put our money where our mouth is, so to speak, right? So. Um, Brokers at the end of the day want a buyer who is a guaranteed close. That's how they get paid, right? On when the deal closes. And so, while they definitely want to show you a nice asset, and it works for you, and obviously someday you can dispose of it and give it back to that same broker to sell it on your behalf. Um, that's really key. Is we are essentially a guaranteed close. We have our transaction process down from PS execution all the way to close of escrow. I'd say our average escrow time is, 30 to 45, 60 days, probably max. And obviously brokers like that. And so with that kind of track record, over the years, brokers recognize that, and they're willing to show us sometimes even exclusive looks where no other group will have a look. They'll say, hey, here you go, Brady, take a look at this deal, get back to me here, within 48 hours. And if it doesn't pencil for you, I'll go to the next guy, but I want to try to get a deal done with you guys. Right. And so that's another big piece as well. We try to, when a deal comes in, we'll log it, and essentially try to get feedback, at least the preliminary feedback of if the deal's on the right track or not within 24 to 48 hours.
I can see that being and tremendously valuable for the broker to receive that feedback, quickly, from you, so they can determine, what their own next steps are. And I know that in most major markets, including the ones that we operate in, there's only a handful of brokers that largely control a majority of the transactions in that market. Are there any specific strategies that, you've used or we've used as a company to find off market or under the radar deals?
Oh yeah, I mean we've we're a group where we really will lean into kind of the blind LOI kind of process, where a broker says, hey, I've been tracking this deal for a couple years, or I've sold it in the past, but I know the seller really hasn't, engaged the brokers to potentially formally list it, or fully market the deal. But if you pencil an LOI, I can put it in front of them. Maybe they will release financials for you to underwrite the opportunity. So I'd say every week we're constantly sending, at least a handful of blind LOIs through the brokers, um, to see if we can dig up again that exclusive look. That's the key.
Yeah, it makes total sense. So now let's kind of maybe pivot into talking a little bit more about underwriting and risk management. So now we've got a deal, on the table, and it's time to dig into the numbers. What are maybe, the top 2 to 3, underwriting assumptions that you find to be the most sensitive, right now, and how are we stress testing those?
Yeah, I mean, for us, when you get sent financials, you can always do, a preliminary sort of back of the napkin, so to speak, underwriting, right? Where is the NOI on the T12 basis? What's the pricing guidance that they're asking for, and kind of what's the entry cap on the T12, right? But and that'll kind of get you at least a general feel for the deal of if the deal is in line or not. But really, that's just the first test: is the deal cash flowing well and operating well today? Um, but we'll take the financials, plug it in, and we're looking at every assumption across the board. In terms of kind of the major um, income and OpEx items. In terms of the income side, we have our operations team personally shop um, the entire unit mix across direct competitors within the 1 to 5 mile radius, plus or minus 5 years vintage, same unit count as well, to try to see what are they truly achieving today on their classic product, on partially renovated scopes and their fully renovated scopes, right? And we'll get 8 to 10 at least comps in our comp workbook to see, okay, if we compare that to the Rise 48 equity scope, where do we think we can operate at as well from the income side, right? So that's very crucial there. On the OpEx side, we own quite a few assets today within each market, so we definitely have our own portfolio that we can benchmark against. And so, we constantly do that in terms of whether it's R&M, advertising, insurance, and taxes are obviously the largest two OpEx items today. And so we'll benchmark against our own portfolio and also rely on our other third party clients, such as our property tax consultants and insurance brokers, to say, hey, I'm looking at this deal in parallel with our underwriting. Can you give us your analysis as well? So that way, by the time I close the deal, my assumption is, in line, if not below, what we had assumed.
Yeah, it makes total sense. It's a really a good place to be when you've got a track record and you've got, several use cases of properties that we currently own, manage, and operate in any given market that we can leverage, as it relates to kind of assessing, whether or not it makes sense to transact on a deal, or even, the monthly KPIs that we benchmark, on the asset management side. So I know that there's this constant kind of tension, right, between being conservative, but then also being competitive. How do you strike that balance so we can win deals without overextending?
Yeah, no, that's a great question. I mean, underwriting is unfortunately not 100% science. Part of it is an art as well, right? You can ask uh, 5 different groups of, hey, where's your entry cap on this deal, and what are you exiting at? And you're probably going to get 5 different answers. They're probably in line of one another, but again, it's kind of the belief, the sponsor's belief there of where they see projections. And we rely on, a lot of our data providers as well. You have CoStar, RealPage, Yardi, et cetera, out there that kind of have their own projections. They have much more data in aggregate than we do readily available to us. So we rely on them to understand and kind of give us at least a base point to go off of, right? But um, other drivers as well, such as location, the deal itself, the deal structure. Um, you know, sometimes we get exclusive looks directly from our lending partners who maybe have taken a deal back in REO from another borrower and are offering us special financing that could really it offloads the asset from their books, but it obviously gives us an opportunity to own the asset at preferred lending structures as well. So it's there's not one or two sort of specific items that really play into that, but it's really the deal as a whole. Is there a distress story there, or again special financing? And outside of all those, does the deal pencil simply on its own as well?
I'm Zach Captainstall, CEO and co-founder of Rise48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Yeah, that makes total sense. So now we're at that point, right, where let's just say the deal does pencil. Now is where the real work begins, right? Which is also something that you focus on internally, and that's really getting the deal over the finish line. And a big part of that, of course, is the due diligence process. So can you maybe walk through, with our listening audience a little bit more about kind of what that due diligence process itself looks like, and maybe even identify a time in the past where the deal didn't pass due diligence and we had to walk away?
Yeah, no, great question. I mean, there's a couple pieces to the due diligence. It's, the underwriting is kind of the first step, right? You underwrite the deal. You're taking anywhere from a couple days to a week or so to essentially fully vet the deal. And then once we submit, an LOI, we've really fully underwritten the deal. There should be nothing that surprises us in terms of, the post PSA execution kind of transaction piece, right? So once the deal is awarded to us, it kicks off kind of two parallels. One is the equity raising side. So we're constantly, getting ready to um, engage our securities counsel to set up, fundraising docs and fund docs for our investors, slide decks, et cetera, to present the deal out. But then also on the transaction piece, I'm also working to source the debt, right? So we source our own debt in-house as well. We'll present the opportunity to all of our lenders with our debt financing request to say, hey, here's the debt terms we're looking for on this asset. I'll field, a bunch of the calls, talking each of the lending groups through the asset. And then once we secure the debt on it, that's where it really opens up, 100 to 200 individual legal and business checklist items for that specific lender. And so, throughout that 30 to 60-day escrow period, we're working to establish brand new SPE entities and operating agreements, bank accounts. Um, uh, the list goes on in terms of transition items for our ops team, et cetera. There's a ton that goes into it where by the time we get to closing, it's wrapped up, kind of bowed, ready to hand off to our investment management team to manage from there.
Yeah, it makes total sense. And I'd like to unpack the debt and financing side of the equation in just a moment here. But for the listening audience, the way that Brady and I work together is basically, him and his team, they find these deals, whether it's direct through brokers or off market, they perform the underwriting on the deal. Once we've been awarded the deal, we've completed, due diligence, or that's maybe in process, but maybe we're a week away from signing the PSA. Brady basically reaches out to me and says, Jeremy, we need $18 million in equity to close this deal. Go find it. Right. So for people that are kind of wondering, how Brady and I work together, really it's, he hands it off to me to raise the equity so that we have the equity check needed in hand in order to be able to close, have that close of escrow date met, based upon our goals there. So just wanted people to understand that. But I would also, Brady, if you don't mind, I'd like for you to kind of explain to us a little bit more about maybe one of the most complex transactions that you've personally, been involved with at Rise. What made that transaction so challenging, and what ultimately got that deal over the finish line?
Yeah, I mean, there was, I guess, the most challenging in a good way, but it was just a lot of moving pieces to it with the transaction. It was actually made up of kind of two transactions, but in 21, 22, we were selling one of our own, disposing one of our own assets, and we were going through a 1031 exchange on the asset there. And so, as part of the 1031 exchange, we obviously give our LPs the option to participate in that as well, to defer, any of their capital gains as well. And so we were selling the asset on one end, but we were also acquiring a different asset on the other side. And so we had, our own essentially tenant in common or TIC structure in that asset where you're also rolling all your LP funds as well, and establishing a brand new fund to make up the difference in terms of the 1031 exchange needed to close that deal. And so it was really two different transactions that made up the kind of process to close that, where obviously in the 1031 exchange, as you're familiar, you have 180 days or so. Timelines were compressed, getting investors to vote if they would like to either redeem their investment or participate in the 1031 exchange, create new fund documents, set up the tick structure, with our new lender as well. That was a 4-member tick as well. And then in that transaction as well, also have an external tick with one of our LPs who had, a sale of a single family asset as well, that want to participate. So there was lots of moving parts that had to be, orchestrated carefully.
Yeah, I've only recently learned about the real process behind executing a 1031 exchange and kind of that whole tick structure. But I do know there's a lot of investors, including those that listen to this podcast, that have expressed interest in executing a 1031 exchange, from maybe a relinquished property into new replacement property. So just want to take this moment in time to kind of shout out if you're one of those types of individuals, that's looking to exit, out of a piece of real estate, maybe that you're an active owner on today and would have interest in partnering with us in that way, please do reach out to myself directly or really anybody else, on the Rise 48 team. So, Brady, I know that none of these deals happen without the right debt structure in place. And I know we kind of alluded a little bit to that, but with today's current lending environment, which is really anybody's guess, with the 10-year treasury still, seesawing upwards and downwards. As of the recording of this podcast, it's September 5th, and the 10-year treasury has dropped about 20 basis points in the last maybe 48 to 72 hours. So we'll see, what the crystal ball says here, as we move on. But, what is it that most lenders, care about when it comes to approving these large multifamily deals that we're buying?
Yeah, I mean, ultimately, if you think about it, right, to buy an asset of this size, whether it's 20, 30, 50, 100 million, right, um, the only way you buy that is if the lender approves of it, right? And of course, the lender is going to underwrite the asset and make sure it works, for sure, right? So there's always a sort of safety net there, to some aspect, to say, look, if you're buying deals of this magnitude, if your underwriting is not in check, the lender will press you on that and say, we're not obviously issuing a loan here. Your assumptions are not in line. So, um, as we shop our own debt, I'm constantly talking to all of our lending partners and the originators, almost every other day, to understand, hey, what are you sizing to, right? We're mainly in the value add 1980s, 90s, early 2000s vintage. And so, a lot of the debt we place on our asset is your traditional bridge debt financing. You have your initial funding issued at closing, and then a future funding facility set up where we can draw upon that to really effectuate our business plan with the interior reno turns and exterior amenities as well. But really, they're looking at, loan to cost, loan to value, their in place debt yield, the stabilized debt yield, and those sort of metrics to make sure the deal pencils from their end. As a lot of these lenders, again, leverage the loan dollars they put out to their other investors as well in different tranches. So it's constant lending on lending game. But if I go back to each lender underwriting the deal will check your pro forma to make sure your underwriting assumptions are in line, and they're obviously a key piece of the pie for us to make sure we can rely on them to understand where we should be underwriting to in today's debt market.
Yeah, it makes total sense. And I'm really glad that you brought up this point, because oftentimes investors don't, understand that there's a significantly large investor that partners with us on every one of these deals. And that's the senior lender. And they're usually writing a check for 65%, maybe 70%, of the purchase price. And certainly they're not going to put forth, that sum of money to help us finance our deals if they haven't already also done, their own due diligence, because the last thing the lender wants is for somebody to hand the keys back to them because they're a lender and they're not a property management company. So you had also mentioned early on, or just a little bit ago, Brady, that we typically like to leverage bridge loans. Why is it that we don't, leverage agency debt or other alternative financing sources?
And across our portfolio, a lot of it has been the traditional bridge financing, just because of the value add business plan. That it provides for that future funding facility, or those dollars to help implement that plan, add the value there, to get the return there. But we've had a couple of deals, two deals we have are agency financing deals. One we have is actually a seller carry, at a fixed rate, 5-year fixed rate, interest only as well. So we'll take advantage of some of those unique structures if presented to us, as well. But with the with the bridge debt as well, there's more lenient prepayment penalties as well. Typically, you have like an 18-month lockout, with no penalty thereafter. But on agency, it's more of a step down, right? As you get, and so it's just what trade off do you want to play with on the bridge side? Typically, it's floating, over SOFR as the index plus the lender spread, and you're really then buying an interest rate cap on the front end. If you go the agency fixed route, you may not get your future funding facility or the capex dollars funded, but you may get hit with a large prepayment penalty in the back end, like a yield maintenance. So it's where do you want to put out those dollars, essentially on the front end of the deal, or essentially the back end.
Yeah, it makes total sense. And from a historical perspective, just in the last few years, we've seen, how much debt can be a friend and a foe. And so, without kind of repeating, historical, in terms of what happened to the debt structure, coming out of, COVID and kind of in that 2021, 2022 era, where is it that, you kind of see, debt markets in multifamily going, over the course of the next, maybe, over the course of really the next market cycle?
Yeah, I mean, we have, as you alluded to, we have an upcoming Fed meeting here. I think as you see the Treasury bouncing around, it's kind of due to some of the uncertainty of what's going to happen. Are they going to cut rates here, or keep them steady? A lot of individuals are assuming, at least maybe a 25 basis point cut here, or maybe they keep it steady. And then maybe, one or two more cuts as we either round out the year or early into next year. Um, a lot of that, I think, is already built in, to some of the debt and financing markets right now. But it's all dependent. You're going to have more cycles in the future, right? It's just what kind of product do you have at that time. For us, I think we've been able to utilize the bridge financing. We underwrite these assets to a 5-year hold period. We really try to add the value, and if we can recognize the gain and get out, we will do so. But if not, we'll look to, we stress test underwriting in terms of agency refinance within that time period, and we'll refi to an agency deal, continue to operate it until we can realize that gain for investors. So um, it's anyone's guess, so to speak, right now. I think with a lot of the um, policies that are happening currently, it's lots of uncertainty. But I think if anything, interest rates will come down here shortly. We have a housing crisis, so to speak, that has to be resolved. We can't continue to play at this level, in my opinion.
Yeah, it makes total sense to me. And yeah, there's a lot of uncertainty still out there right now. But I know one of the primary drivers behind maybe the 10-year Treasury slipping in the last couple of days is really related to unemployment. Not necessarily related to inflation. And the Fed really has that dual mandate, right? Keeping inflation in check while at the same time growing the economy. And a big part of that, of course, is job growth. And when unemployment ticks up, from, month over month, that causes a little bit of a panic and uncertainty, as well. So, and then of course you've got, what are the impacts of the ongoing tariffs? I I heard that, since the tariffs were imposed, the United States has brought an additional $8 trillion of income or revenue as a direct result of that, which is a huge impact, to the U.S., balance sheet overall. But on the other side of that equation, of course, that can cause and can fuel, further inflationary pressures as well.
Right. Yeah, but I think a lot of that's just the uncertainty, right? Obviously tariffs are uh, not the norm, and at least the past couple of generations, I'd say. And so it's sort of a new thing, and the Fed is probably just uneasy on what the turnout is there. But there's been a few meetings now where I think they understand, hey, it's more of a stable level potentially to make some decisions here going in the future.
That's great. Well, Brady, this has been a great conversation. You brought the heat today. You brought the value. So really appreciate, you being a part of the show.
No, I appreciate you having me on. Thanks, Jeremy.
Absolutely. And listening audience, thank you again for jumping into yet another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting.